accounting journal entries that convert a company's accounting records to the accrual basis of accounting. An adjusting journal entry is typically made just prior to issuing a company's financial statements. Is it necessary to make adjusting entries? Adjusting entries are necessary because a single transaction may affect revenues or expenses in more than one accounting period and because all transactions have not necessarily been documented during the period. To describe adjusting entries, should be able to understand 5 points. First, how profit is measured and reported under the accrual and cash basis of accounting. Second, identify the 4 major circumstances in which adjusting journal entries are necessary. Third, record and post adjusting journal entries, and prepare an adjusted trial balance and financial statements. Fourth, describe the purpose of the closing process and prepare closing entries. And last one, describe the steps of the accounting cycle. Ensure that revenues and expenses are properly recorded under an accrual basis. Accounting information systems use adjusting journal entries. Adjusting journal entries are entries made in the general journal to record revenues that have been earned but not recorded, and expenses that have been incurred but not recorded. Entries mode in the general journal to record revenues that have been earned but not recorded and expenses that have been incurred but not recorded. While adjusting entries can vary significantly across companies, they all arise because the exchange of cash does not always coincide with the earning of a revenue or incurrence of an expense. For example, sometimes cash is received before a revenue is earned while at other times cash is received after revenue is earned. Likewise, sometimes cash is paid before an expense is incurred while at other times cash is paid after an expense is incurred. The table shows that 4 basic scenarios which are the reasons that adjusting journal entries are necessary. All of the preceding adjusting entries are journalized and posted to the ledger. An adjusted trial balance can be prepared. Like the previous trial balance, the adjusted trial balance simply lists all balances from the ledger. Since the ledger now reflects several adjustments, so does the adjusted trial balance. Once all revenues and expenses are recorded and an adjusted trial balance is prepared, financial statements can be generated. The purpose of adjusting entries is to record revenues that have been earned but not recorded and expenses that have been incurred but not recorded. Then every adjusting journal entry will affect at least one revenue or one expense account. In addition, every adjusting journal entry will affect at least one asset or liability account. This means that every adjusting entry will affect at least one account from the income statement and one account from the balance sheet. Finally, adjusting journal entries arises because the timing of revenue and expense recognition differs from the exchange of cash. Therefore, cash will never be increased or decreased in an adjusting entry.